Be Wealthy and Smart, episode 913.
Step into a world of wealth and financial freedom without budgets, boredom, or bosses on Be Wealthy and Smart. And now, here's your host, Linda P. Jones.
Welcome to Be Wealthy and Smart. I'm Linda P. Jones, America's Wealth Mentor, empowering women and men worldwide to financial freedom. On today's show, we're going to talk about 10 ways to become a 401k millionaire. And I thought this was a fun article to talk about. It was written by Stephanie Colstock on Yahoo Finance. And there are 10 specific steps they're going to give you, and we're going to talk about these. The article says the number of 401k and IRA millionaires reached an all-time high in the first quarter of 2021, according to Fidelity Investments. Retirement account balances have been steadily recovering in the years since COVID first emerged, even surpassing pre-pandemic levels. Today, more than 365,000 Fidelity investors boast seven-figure 401k balances, along with more than 307,600 IRA millionaires. A well-funded retirement account can afford you the financial security you need after your career ends. But to become a 401k millionaire, there are several steps you'll need to follow. There are 10 key moves a 401k investor should make to maximize his or her opportunity to retire as a 401k millionaire. Of course, there's no guarantee that following these steps will turn you into a millionaire, but it's unlikely you'll reach such a level without making a number of the following moves. Number 1, start early. One of the most important factors for your retirement account, or really any investment, is time. The earlier you begin contributing to your 401k savings account, the longer your money has to grow and the greater your returns can compound or multiply. So I just want to pause there and say, does that sound like the wealth building formula, McT, money, compounding, and time? Here they're talking about time and starting early. So yes, absolutely, you want to start as early as possible. The article goes on to say, by starting your retirement savings efforts as early as possible, you increase your chances of becoming a 401k millionaire and successfully funding your future. What if you're getting a late start on your retirement savings though? Do you still have a chance at meeting your goal? In part, the answer to that depends on how much you save each year from this point on, and how your retirement savings are invested. Starting today is still better than starting tomorrow or a year from now. However, especially if you can save as aggressively as possible now. Number 2, calculate what you need. Saving $1 million for your retirement is an exciting goal to set. But is it the right goal for funding the future lifestyle you have in mind? Odds are that your current spending habits and budget are different from those of your coworkers, your best friend, and even your siblings. Your plans for retirement probably differ too. Some people plan to enter retirement debt-free, for instance, spending their years gardening and visiting their grandkids. Others want to finally travel the world in retirement or buy their dream home at the beach. It's important that you spend some time deciding what you want your retirement to look like and how much that lifestyle will realistically cost. In some cases, you may not even need $1 million, especially if you have other assets to pull from. For others, though, having $1 million in a 401k won't be enough to last. Set your retirement savings goals accordingly in order to properly fund the future you're eyeing. Number 3, contribute regularly. One great thing about a workplace-sponsored 401k is that your contributions can be automated. Your employer can take the funds out of your paycheck before the deposit ever hits your account, ensuring that you pay yourself first every single month and meet your goals. In some cases, though, your retirement savings may not be automated. If you're a small business owner, for example, you may need to set up a simple 401k or a solo 401k. In that case, you'll be responsible for setting up your own contributions and meeting your own savings goals. Be sure that whatever retirement savings vehicles you choose, you are contributing regularly and consistently. Number 4, invest the maximum. The more you save today, the more your retirement savings will grow and the better your chances of meeting your goals. Whether you want to be a 401k millionaire, are aiming for early retirement, or simply want to be financially independent, saving the maximum you can afford each month will get you there. The IRS limits the amount you can save in your 401k each year. For 2021, this limit is $19,500. Or if you're over age 50, you can deposit an extra $6,500 as a catch-up contribution. If your budget allows, try to max out your contributions to better your chances of saving success. If $19,500 a year isn't doable for you, simply invest the maximum that you can afford. Aim to save at least 10 to 15% of your income and watch your balance grow. Number 5, take advantage of an employer match. An employer match on your retirement contributions is one excellent way to amplify your savings efforts. This is essentially free money, and you should avoid leaving it on the table if at all possible. If your employer is offering to match a portion of what you contribute to your retirement savings, you should ensure that you are depositing at least enough to max out this match. The maximum is usually a percentage of your salary, often between 3 and 5%. Also note that the funds may be vested. This means that you only get the full match amount if you stay with your employer for a minimum amount of time. If you quit your job before that vesting period ends, you won't get the full match. Number 6, maximize your investment potential. Your employer may offer multiple investment options for your 401k. If this is the case, spend some time researching each option so you have the best chance of maximizing your returns. Consider your risk tolerance and when you plan to retire. The further you are from retirement, the more risk you can afford and the higher your potential returns. Also be sure to weigh each fund option in terms of expenses. Number 7, limit your fees. Your 401k will involve various fees and expenses which will vary from one plan to the next. While these fees may seem small, often a fraction of a percentage point, they can really add up over time. The fees on your 401k will be automatically deducted, so you may not even recognize how much your plan is costing you. Every dollar that you spend on retirement plan expenses is a dollar that can't grow and compound for your future. Do your best to balance projected returns with planned costs and consider switching plans if there's an opportunity to save on fees. Number 8, new job, rollover funds. Each employer will offer its own retirement plan options. When you change jobs, you may be offered a managed plan with your new employer, which may be better than the plan that's currently holding your funds. You have 3 primary options for your existing 401k savings when you change jobs. You can leave it where it is with your old employer, or you can roll it over to your new employer, or you can roll the funds into an IRA. If you have enough money in the 401k, usually $5,000 or more, most plans will let you leave it alone, which could be a good decision if you are seeing great returns there and are happy with the plan's expenses. However, if you have less than $5,000 in there, aren't moving to a new job just yet, or aren't otherwise happy with the plan's management or fees, a rollover is a better idea. The first route to consider is rolling your money into a traditional IRA. This may be the best choice if your new employer doesn't offer a 401k, you don't have another employer lined up, or you just want to have more flexibility with your account options. IRAs are offered by nearly every brokerage and give you a variety of options for your money. The second option is to roll your savings into your new employer's 401k. If they offer better funds or lower fees and expenses on plans, this is probably your best move. So I want to pause right there and say I disagree a little bit with that. If you leave a company, I would recommend you roll that into an IRA because you have more selection available in terms of what your investments can be. You have individual stocks open up to you, you have sector ETFs, you have a variety of choices that broadens when you're in an IRA. When you're in a 401k plan, your choices are very, very limited. And usually there's 20 or less choices in a 401k. So it's great to roll it over into an IRA and really have thousands of things available. Really anything you can think of, you can invest in. Number 9, leave the money alone. Whether you're trying to reach 401k millionaire status or just want a successful retirement, there's one important rule to keep in mind over your decades of saving. Don't touch the money. No matter what life throws at you, avoid the temptation to pull from retirement accounts. Early withdrawals can not only derail your progress exponentially, but will also subject you to penalties and fees. In most cases, it's not worth the added cost. If an unexpected situation arises, consider the alternative options available before pulling your retirement funds ahead of schedule. In many cases, a personal loan or home equity line of credit, a HELOC, could meet your needs just as well. And number 10, don't forget other retirement savings. While a 401k is the most popular retirement account option, it's not the only one. Depending on your saving strategy and how much you have to save, you may want to consider spreading out your retirement efforts across a variety of different savings avenues. A traditional or Roth IRA can be another great option for retirement savings, especially if you're already maxing out your 401k contributions. You may also choose to focus on a personal investment portfolio. There, you can invest in funds that your employer doesn't offer or even individual company stocks. You can also utilize real estate investments such as rental property or real estate investment trusts, REITs, to bolster your retirement cash flow. They won't include the same tax advantages as 401ks or IRAs, but can be a great addition to any well-funded retirement strategy. Saving for retirement is a decades-long journey, whether you're aiming for a 7-figure balance or comfortable security. Of course, there's no guarantee that following these 10 steps will turn you into a 401k millionaire, but by following them, you'll better your chances of reaching your retirement goals and feeling financially secure after you retire. End of article. So I just want to say one more thing, and that is in the high fee section are target date funds. So if you are invested in target date funds, I recommend that you get your money out of those. And if you want to know why, you can go to my website at lindapjones.com/podcasts. And in the search box, put target date funds, and it will pull up all of the podcasts I've done talking in detail about why target date funds are not a good place for you to invest. So check that out on my website and get out of those high fee bearing accounts. That's all for today. Until next time, live the good life and be wealthy and smart.
Thank you for listening to Be Wealthy and Smart with Linda P. Jones. Share the wealth and tell your family and friends about the show. Check out our website, blog, and social media for more riches at www.bewealthyandsmart.com.